may have heard of ESG reporting, but what is it and why is it so important? This tutorial will give you a brief overview of ESG reporting and how it's changing and evolving. ESG is short for environmental, social, and government. Sometimes those terms can be expanded to environmental protection, social inclusion, and government. These three aspects of society are closely related as they all work towards ensuring that the environment remains sustainable for future generations. They also improve living conditions on our own planet by promoting good governance practices which lead to efficient public policies with purposeful outcomes at home or abroad. In 1987, the United Nations Brundtland Commission defined sustainability as meeting the needs of the present without compromising the ability of future generations to meet their own needs. ESG is not just about the environment. It's also about focusing ethical and sustainable outcomes that will benefit everyone in society, including future generations. One reason why ESG reporting is so important is because it can help organizations discover new business opportunities. For example, let's say an organization wants to reduce its carbon footprint. To do this, the organization might need to invest in new technologies or change its manufacturing processes. By discovering these opportunities, organizations can save money and increase their competitiveness. Another reason why ESG reporting is so important is because it helps organizations mitigate risks. For example, let's say an organization wants to avoid supply chain disruptions. To do this, they might need to map their supply chain and identify risks. By mitigating these risks, organizations can protect their reputation and bottom line. Businesses are now incorporating sustainability into their mission and everything they do. The shift has been from an emphasis on the nice to have to a holistic approach that includes social purpose, meaning that ESG is included in every decision made by these organizations. Many investors are interested in ESG data when considering where to invest their money. The biggest firms in the world aren't the only ones responsible for this effort. For example, practically every company has the chance to make adjustments that lessen their carbon impact. Making adjustments like sourcing materials from ethical sources, conserving energy, and optimizing shipping procedures are positive steps in the right direction. Adopting an ESG strategy may appear unrealistic to some in a society that prioritizes profit over meaning, but businesses have repeatedly demonstrated that it's possible to make money while doing good. Nike and Patagonia are both examples of companies who prioritize doing good while maintaining profitability. Other terms related to ESG that you may see include CSR, triple bottom line, and integrated reporting. CSR stands for Corporate Social Responsibility. CSR is the concept that companies should consider how their actions may impact society and the environment rather than a sole focus on profitability. The triple bottom line is an approach to business that emphasizes measuring social and environmental impact in addition to financial success, rather than focusing solely on the traditional bottom line or earning a profit. Profit, people, and planet are the 3 P's of the triple bottom line. Integrated reporting is comprehensive reporting of all the elements that affect a company's ability to create value over the short, medium, and long terms. Through integrated reporting, both financial and non-financial measures that reflect a company's efforts to create organization value are communicated. Most publicly owned companies publish some kind of ESG report. Some of that reporting might be disclosed in integrated reporting, and some might be included in annual reports. Standalone sustainability reports account for most ESG reports. The reporting standards currently being used for ESG reporting are diverse, with most businesses relying on numerous standards and many employing one or more well-known frameworks. Frameworks you might see include GRI, ISSB, UNGC, and TCFD. We will talk briefly about each of these frameworks. Global Reporting Initiative, GRI, The GRI is a global independent standards organization that helps businesses, governments, and other organizations understand and communicate their impacts on topics such as corruption, climate change, and human rights. GRI is the most widely used reporting framework at the present time. International Sustainability Standards Board, ISSB. The ISSB is a newly formed board formed by combining several existing sustainability reporting framework organizations, including the Sustainability Accounting Standards Board, the Climate Disclosure Standards Board, the Integrated Reporting Framework, and others. The ISSB will deliver comprehensive global sustainability-related disclosure standards that provide investors and others with information about companies' sustainability-related risks and opportunities to help them make informed decisions. United Nations Global Impact Compact, UNGC. The UNGC is a mechanism for businesses to promote and advance the Sustainable Development Goals of the UN, which have been ratified by all UN member states. The UNCG is a voluntary project based on CEO promises to implement universal sustainability principles. Task Force on Climate-Related Financial Disclosures, TCFD. The TCFD is a voluntary framework of recommendations on climate-related financial disclosures that can be used by organizations in all industries and locations. The recommendations can be used by organizations to assist in the preparation of disclosures that are uniform and comparable. Because there is no single recommended ESG reporting framework, the comparability of ESG reports between companies is limited. Companies use different frameworks to report ESG information, making ESG information difficult to compare. One other issue impacting ESG reporting is the reliability of the reports. At this point, companies in the United States are not required to have third-party assurance for their ESG reports. What this means is that there is no independent verification of ESG reporting data. Hopefully, companies are reporting reliable quality information, but without third-party assurance, one cannot be sure, and the reports need to be analyzed with a skeptical eye and an awareness that there is no third-party assurance. Accounting, engineering, and consulting firms provide third-party assurance for ESG reports, so investors can trust that the ESG disclosures are reliable. Some businesses report using assurance services in their ESG reports. When an ESG report specifies it has undergone third-party assurance, that means an independent party has checked the reliability of the report contents so investors and others can be more confident that the reporting is consistent with reporting standards. Measures of ESG performance are generally categorized as environmental, social, and governance. The measures used will vary by industry. Examples of environmental measures could include total energy consumed, total water withdrawn, percentage of renewable energy used, gross global Scope 1 emissions, and amount of food waste generated. Examples of social measures include voluntary employee turnover rate, average annual volunteerism hours per employee, number of work-related injury claims filed, and ratio of basic salary of women to men. Finally, examples of governance measures include percentage of board members who are women or minorities, percentage of board members who have completed anti-corruption training, and percentage of employees completing customer privacy training. Comparability among companies is important when evaluating ESG performance. Company size can impact comparability. For example, if the number of safety training hours was compared between two companies, we would expect a company with 20,000 employees would have more safety training hours than a company with just 1,000 employees. To increase comparability among companies of different sizes, ratio analysis can be used. Instead of comparing the number of safety training hours, the number of training hours for each company could be divided by an activity base, such as the number of employees. Let's look at an example of this ratio analysis with ESG data. We have two companies, Company A with 20,000 employees and Company B with 1,000 employees. Company A reports that employees completed 30,000 hours of safety training, while Company B reported that its employees completed 4,000 hours of safety training for the same period. We would expect Company A to have more safety training hours just because of its size. Which company invested more heavily in safety training? If we just look at the number of hours, it looks like Company A did better, but we need to look closer. To answer the question of which company invested more into safety training, we would take the total safety training hours for each company and divide those hours by the number of employees at that company to get a per employee safety training hours average. For Company A, we would take 30,000 hours and divide by 20,000 employees to get an average safety training hours of 1.5 hours per employee. For Company B, we would take 4,000 safety training hours and divide by 1,000 employees to get an average safety training hours of 4.0 hours per employee. On a per employee basis, Company B actually invested more in safety training than Company A. That point would not have been obvious without creating the ratio or the average safety training hours per employee. Accountants who work at accounting firms can support ESG by working on third-party assurance for ESG reports. Accountants who work at companies can support ESG efforts within their companies. An accountant could conduct an analysis of the company's carbon footprint and recommend ways to reduce it, or evaluate the company's supplier diversity program and make recommendations for improvement. The accountant is also well positioned to help the company develop internal controls to prevent bribery and corruption, and to assess the company's risk exposure to climate change and develop mitigation strategies. The accountant can also analyze the company's financial statements to identify areas where ESG reporting could be improved, and can also participate in the disclosure of material ESG risks in SEC filings. The state of ESG reporting is constantly changing and evolving rapidly, presenting several opportunities for accountants. By understanding the key issues and differences between traditional accounting practices and ESG reporting, accountants can position themselves as advisors to companies looking to adopt or improve their ESG policies. Researching organizations like the International Sustainability Standards Board, ISSB, the United Nations Global Compact, UNGC, and the Global Reporting Initiative, GRI, will continue to help develop and evolve ESG reporting standards so that ESG reporting becomes more reliable and comparable across companies. Okay, that's it. We are done. This video was created and narrated by Dr. Wendy Tietz. Have a great day.